Are you new to the home buying process and wondering about different loan programs? What's the difference between them? Which one is right for you? Well, in today's video, we're going to go over the most popular loan programs out there, like conventional loans, FHA loans, USDA loans, as well as VA loans. We're going to go over some of the differences in those loans. We're also going to address some of the first-time home buyer myths out there with regards to loan programs. One, for example, is that you need 20% down in order to be able to purchase a home. Absolutely not true. You can actually purchase a home with zero money down depending on the type of loan that you do, and also that there's some specific first-time home buyer loan programs out there. And in reality, there's not, right? There are certain programs that allow you to use a minimal down payment, and oftentimes those are labeled as first-time home buyer loans, when in reality, anyone can use them to purchase a home. Now, as we're going through this and you're hearing about different types of loan programs and deciding on which one you're going to go with, what I would suggest is when you talk to a mortgage professional, have them run comparable numbers for whatever type of program it is that you're interested in. Have them run it if you're interested in maybe considering FHA and also considering conventional. Have them run the numbers side by side so you can see exactly how much money you need to bring in with regards to down payment, with regards to closing costs, and what it looks like at the end of the day with regards to your monthly payment. This will help you in deciding which loan program is best for you, because each one of them has their pros and has their cons, which is some of the stuff that we're going to address in today's video. Before we dive into it, I want to take a minute and ask a favor. If you find any value in this content at all, if you learn anything, hit that thumbs up. And if you have any questions, do me a favor, leave them in the comments below. I always go back and try to address those and help guide you in the right direction. And the next thing I want to say before we dive into the different types of loan programs is if you're out there looking, to get pre-approved, you don't have a lender, do me a favor, click the link in the description below. I'm happy to refer you to somebody that does business the way that I do, somebody that I know personally, regardless of where you are in the United States. Now, keep in mind, I don't get anything from this other than knowing that you're in good hands. But do me a favor, click that link if you need to be referred. The first loan program I want to talk about today is FHA, because FHA loans are often associated with first-time home buyers, and that's because they allow a minimal down payment. Now, we are going to talk about some of the loan requirements in today's video. We're not going to dive into each little detail of them, but at the end of the video, I will give you a link to another video if you want to get some more information on each of these programs. But FHA, some of the benefits, some of the pros of this loan is that they allow you to purchase with as little as a 500 credit score. Now, with 500 credit score, you have to put 10% down, but if you have at least a 580 credit score, you can purchase with 3.5% down. Now, with FHA, one of the downsides, one of the cons, if you will, is it has to be an owner-occupied property. It has to be your primary residence. You cannot use FHA to purchase investment property. Another con on the loan is that they have monthly mortgage insurance. So every single month, you're going to pay mortgage insurance because you're putting less than 20% down. And unfortunately, that mortgage insurance is going to stay with you for the life of the loan when you put less than 10% down. So if you're only doing 3.5% down, you're going to have mortgage insurance on that FHA loan for the life of the loan. In addition, you're going to pay an upfront mortgage insurance premium. So when you finance an FHA loan, you're going to put your 3.5% down, but you're going to be charged a 1.75% upfront mortgage insurance premium that's going to be added back to your loan amount. Now, it can be financed, but it's something that you have to keep in mind when doing FHA versus some of the other loans out there like conventional. And one of the last things we'll talk about with regards to FHA is the fact that their guidelines are more lenient. They allow lower credit scores, as we mentioned earlier, but they also allow a higher debt to income ratio, which means that you can actually have more of your income going towards debt every single month, which means that you can likely qualify for more home using an FHA loan versus a conventional loan. Now, the second loan we're going to talk about in today's video is a conventional loan. Now, typically when you put 20% down to purchase a property, you use a conventional loan. And that's often why people believe that you have to have 20% down in order to buy a home. But we mentioned that was a myth earlier. You can actually get it done with way less, as we just witnessed with the FHA loan. But a conventional loan, you can put as little as 3% down. The caveat is you need much higher credit scores with conventional to do that 3% down than you do with FHA. Conventional, you can get away, as I mentioned, with 3% down, but you need high credit scores in order to do it. You're going to really want to be above 740 with regards to FHA putting 3% down, but you can also do it with as little as 5% down. So if you only have 5% down, you may consider a conventional loan versus doing an FHA loan. One of the benefits of using conventional is that although you do have monthly mortgage insurance on that loan, you don't have the upfront mortgage insurance premium that FHA loans have. Now, if you end up keeping that same loan, that same conventional loan, and you end up paying down your equity 22%, so now you have a 78% loan to value on that loan, that mortgage insurance on that loan will automatically fall off. Now, earlier you heard me mention with FHA, it's going to stay on it for the life of the loan. With conventional, it will eventually fall off once you have that equity in the property. Another benefit of using a conventional loan is not only can you purchase an owner-occupied property, a primary residence, but you can also use it to purchase investment property. Now, unfortunately, with investment property, you are going to have at least 20% down when purchasing investment property using a conventional loan, but you do have the option. Whereas, as we mentioned earlier, with FHA, it's only for a primary residence. The last thing we'll talk about with conventional financing, and it's one of the cons, is that the guidelines are a little bit more strict. Not only are you going to have higher credit scores, but they aren't going to be quite as lenient on the debt to income ratio. So you're not going to be able to qualify for quite as much home, typically speaking, with conventional versus an FHA loan. Now, the next loan we're going to talk about today is a USDA loan. Now, this is one of the loans out there that truly does allow you to purchase with no money down. So you can actually buy a home 100% financing with no down payment. But with that said, there are some requirements on USDA that they don't have on other loans. One of those requirements is that the property has to meet eligibility requirements and it has to be deemed rural. There is a link, which I'll put in the description below, where you have to go to check to see if the property that you're looking for actually meets the eligibility requirements to do a USDA loan. Another one of the things that you have to consider when using USDA is that they also have income restrictions. You can't make more than a certain amount of income when using a USDA loan. So the property has to qualify to meet their requirements, but your income also has to qualify. You can't make more than a certain amount of money in order to use a USDA loan. Now, some of the other things to consider is USDA doesn't really have a minimum credit score requirement, although having a 640 or above is probably more beneficial to actually getting the financing approved. In addition, they do have an upfront fee. It's called a guarantee fee. It is 1% of the loan amount, and that's actually financed into the purchase price of the property, but you're going to pay that on every single loan with USDA. In addition, you're going to have a monthly mortgage insurance premium that you're going to pay every single month, similar to FHA. It's actually less than FHA, but it is going to be a fee that you pay every single month, and that's one of the things you need to keep in mind when doing a USDA loan. And lastly, USDA only allows you to finance primary residences, no investment property. In fact, you can't buy a property that has any income producing pieces, if you will, on the property. You can't buy a property, for example, that has a farm that makes money or something like that, right? It can only be to finance the property itself for primary residences, so no investment property. Now, the last loan we're going to talk about today is actually the best loan of all of these in my opinion, but you have to be eligible in order to use it, and that is a VA loan. These loans are for veterans. You have to have, certain eligibility requirements, which I'm not going to discuss in today's video, but I will link to it here at the end of this video where you can see if you qualify, if you've actually served in the military. But VA allows you to purchase at 100% financing, no money down. And one of the key benefits here is that although you're putting no money down, you also have no mortgage insurance. So you're not paying any mortgage insurance every single month because you put less than 20% down, like you do with a conventional loan or a USDA loan or a conventional loan for that matter, right? So there's no monthly mortgage insurance, which is a huge benefit. Now, some things to keep in mind with VA loans is that they do allow lower credit scores, right? There's not really a minimum credit score requirement, although it might be 580. If you do have credit scores in the low 600s, you're still going to get more or less the best interest rates out there when it comes to VA financing. In addition to that, VA requires that it is a primary residence. So you have to live in the property. It can't be an investment property. I often have veterans reaching out to me saying, hey, listen, I work in Texas, but I want to buy a house in Florida. Can I do that? Well, only if you can make the lender make sense of it, right? If you're going to live in it as your primary residence and you can show that you're going to be there, then they would allow you to purchase that. But if you're going to be living in Texas, they're not going to allow you to purchase a primary residence in another state. Now, VA does have a little stricter debt to income ratios in most cases, but I've had clients with as high as a 67% debt to income ratio get approved using VA financing. So ideally, they'd like to see you have debt to income ratios in the mid to low 40% range, but I have seen VA accept borrowers at 100% financing, putting no money down, as high as 67%. So they are lenient on what they will allow. So in some cases, they can be a little more lenient. You just have to meet their criteria, and many times, you know, you're not going to know for sure without actually going through the process and being pre-approved. So, you know, if you need, again, a lender that can do that for you, do me a favor, click that link in the description below. So that should give you a really good idea of the different types of loan programs out there, you know, FHA, conventional, USDA, and VA. Now keep in mind, with all of these loan programs, you're going to need to have steady income and employment, right? All of them typically want to see at least 2 years on the same job, in the same line of work. Now, I often have people reaching out to me going, well, I've changed jobs. Am I still eligible? In most cases, the answer is yes, as long as you stayed in the same line of work, right? So if you were a mechanic and you went from one job to the next job and you're still a mechanic, that's the same line of work. They just want to see that you've been consistently doing the same thing for around 2 years. Now, it doesn't have to be exactly 2 years. In some cases, it can be a little bit less, but that is generally what they want to see. Now, what they don't want to see is when you go from a W-2, a wage earning job, to becoming self-employed, right? That's usually a no-no. And oftentimes, it might be difficult to get approved when doing that sort of thing. So you need to have steady income, steady employment. But if you're watching this and wondering, you know, if you qualify, you have questions about different things, you know, again, talking to a lender, going through that pre-approval process, having them analyze your credit report, you know, run your credit, take a look at your debts, your credit scores, taking a look at your tax returns, your pay stubs, your assets, and just telling you exactly where you stand. That is the ideal situation to go through, you know, versus watching this video and just saying, hey, I meet the eligibility requirements, I must be able to purchase a home. No, you still need to go through the pre-approval process. So, you know, make sure you do that if you're considering buying a home. And if you have more questions about these different types of programs, whether it's FHA, conventional, USDA, or VA, you know, there's a video right here surrounding me right now. Click on the one that interests you. You can get some more information in there. I break it down in more detail. But for now, I appreciate you taking the time to watch. I appreciate all the support. Hope to see you again soon. Have a great day. Bye-bye.